In 1835, Richard Lawrence pointed two pistols at Andrew Jackson from 6 feet away and pulled both triggers. Both misfired. This was the first assassination attempt on an American president, occurring just 3 weeks after Jackson had paid off the entire national debt. It was the only time in recorded American history that figure reached 0. For a long time, historians called the proximity of these events a coincidence. But when you look at the Treasury ledger from that January, the page where the debt is recorded as nothing, and place it next to the account of the failed assassination, the word coincidence begins to feel inadequate. On January 8, 1835, the United States Treasury recorded a balance that has never appeared on its books before or since. The national debt stood at $0.00. It wasn't just reduced or refinanced, it was gone. Andrew Jackson had spent the better part of his presidency fighting to make that number possible. The system he fought within to reach it does not resemble anything we would recognize today. To understand what Jackson achieved, you first have to understand what he destroyed: the Second Bank of the United States. The Second Bank was not a government institution. It was a private corporation operating under a federal charter headquartered in Philadelphia. It had the authority to hold government deposits, issue banknotes, and extend credit to merchants, land speculators, and, critically, the congressmen who voted on its future. Its president, Nicholas Biddle, managed its resources with the confidence of a man who understood that controlling credit meant controlling outcomes. When Biddle needed a favorable vote, he extended loans to the men casting them. The congressional record documents this. It was not subtle. Jackson called it a hydra-headed monster. In his 1832 veto message, a document that read more like an indictment than a legal brief, he argued that the bank concentrated power in private hands. He believed it favored the wealthy merchant class over farmers and laborers, and that it was incompatible with a republic where value was supposed to derive from land and physical work rather than interest-bearing paper. While his enemies called the veto economically illiterate, his supporters saw it as the only honest thing said about money in a generation. What replaced the bank was not the chaos often implied by official history. Instead, Jackson implemented an independent treasury system that routed government funds through its own vaults rather than private banks. This economy was tethered to hard money, gold and silver, rather than banknotes whose value depended on the reputation of whichever private institution had printed them. Land sales and customs duties filled the treasury. Neither required borrowing from a central lending authority, and neither created a permanent class of creditors with claims on the federal government. The $19 million surplus that accumulated by 1835 was the arithmetic result of a system functioning exactly as intended: spend less than you collect, hold what you collect in hard assets, and owe no one to anyone. Today, we treat a debt-free government as a fantasy, something that requires magical thinking. But the economy of 1835 did not depend on a central bank to manage the money supply. Value was tied to physical existence: the land under survey, the gold in the vault, and the goods moving through the ports. Jackson understood this distinction with clarity because his background was not financial. He was a land speculator turned military commander. He had watched paper money collapse before and had seen men lose their farms to creditors holding notes backed by nothing. For him, the bank war was personal. By the time the debt hit 0, Jackson had been in office for 6 years. He had vetoed the bank's recharter, removed federal deposits from its branches, and survived both an impeachment inquiry and a Senate censure. The 0 in the ledger on January 8, 1835 was the result of a sustained political fight against the most powerful financial institution in the country. For one brief moment, the surplus sat there and the debt was gone. Then the counter-reaction began. In July 1836, Jackson signed the Specie Circular, an Exeter order requiring that the federal government accept only gold and silver as payment for public land. He wanted to cool the rampant speculation fueled by state banks that had been multiplying paper deposits through excessive lending. The order worked, but it had a cost. When land buyers could no longer pay in banknotes, demand fell. State banks, holding collateral worth less than the loans they had issued, began to collapse. Jackson left office on March 4, 1837. By May, the banks suspended payments, and by summer, the Panic of 1837 had arrived. Martin Van Buren, Jackson's successor, inherited a crisis he didn't create. He spent his term defending the independent Treasury against a Congress that wanted to return government money to private banks. He failed. The system was repealed in 1841, the same year the surplus vanished, and the same year the national debt began its permanent climb. Reasonable historians have argued for nearly 2 centuries whether the specie circular caused the panic or merely accelerated pressures already building. But the timing remains the glaring piece of evidence. The man who paid off the national debt exits office within 60 days, and the economy he spent his presidency protecting collapses. The central banking system he defeated was eventually rebuilt in stages, culminating in the Federal Reserve Act of 1913. Critics of the bank at the time, like Senator Thomas Hart Benton, described what followed as a demonstration rather than a natural correction. The argument was that the international credit system needed to prove a point that a country that removed itself from central banking would suffer, and that the suffering would be blamed on the removal itself. Whether this framing is correct is a question the evidence cannot fully settle, but the results are clear. The $190 million surplus was gone, and the zero in the ledger lasted less than 2 years. We are often told that the Federal Reserve and central banking brought stability to a century of financial chaos. Textbooks point to the panics of 1837, 1857, 1873, and 1893 as evidence that the economy needed professional management. But what they don't mention is that every one of those panics followed a period of rapid credit expansion by private banks. Every contraction was a credit contraction first. These panics were not random failures. They were the predictable output of a system designed to redistribute assets from debtors to creditors. The infrastructure built during the years of low or zero debt, the canals, the federal buildings, the granite customs houses, was funded without borrowing from a central lending authority. The Erie Canal, for example, was financed through state bonds backed by projected toll revenue, not central bank credit. The financing model that built these enduring structures was declared unworkable only after the alternative had been forcibly removed. The story of 1835 is a reminder that the national debt is not an inevitability of nature, but a feature of a specific design. The ordinary zero written in a clerk's hand on a Tuesday in January remains a ghost in the machine of American finance, a brief window into a world where the government owed no one to anyone, and the hydra-headed monster had finally been laid to rest.